Money, call it bread, cash, dough, or lucre, it matters. Across history, many have argued that the love of it is the root of all evil, but historian Niall Ferguson challenges this view, arguing instead that the ascent of money has been essential to the ascent of man. Today, our financial world is truly colossal. In 2006, the world's economic output was about $47 trillion, but the total value of outstanding derivatives had already reached $473 trillion, more than 10 times larger. Every day, $2 trillion change hands in foreign exchange markets. Are you baffled by the enormous gap between the haves and the have-yots? Are you angered by fat cat capitalists? This video series illuminates the financial secrets behind every great historical phenomenon, from the rise of the Medici to the current subprime crisis. If you want to understand the modern financial system and avoid being financially illiterate, this history is crucial for your own life. So, stick around, and if you find value in learning these vital lessons, please subscribe right now. Segment 1. Dreams of Avarice, the Birth of Banks. Imagine a world without money. Hunter-gatherer societies like the Nukok Mako had no concept of money or the future, living a life that was solitary, poor, nasty, brutish, and short. Money's evolution began with metals, moving to mere clay tablets and printed paper. But money is fundamentally based on one thing: trust inscribed. The earliest financial instruments from ancient Mesopotamia, 2nd millennium BC, were clay tablets. These documents, recording loans and specifying repayment to pay the bearer, demonstrate the transferability of debt. This new system of organized credit proved essential, allowing savers to channel money to the industrious poor rather than letting loan sharks exploit them. The Medici family in Renaissance Florence perfected the system. They rose to power not just as moneylenders, but as foreign exchange dealers who utilized double-entry bookkeeping and decentralized partnerships to spread risk. Banking, far from being the work of mere leeches, has historically been an indispensable factor in human advance. Segment 2. Of Human Bondage, When Debt Rules the World. The bond market, the second great revolution in money, is immensely powerful. Political figures like James Carville have confessed their awe of it, saying, "You can intimidate everybody." Why? Because the bond market sets long-term interest rates for the entire economy. Historically, bonds financed war and empires. Florence financed its incessant military conflicts by issuing Monte Comune, literally a debt mountain, to its wealthy citizens. Later, Nathan Rothschild built his fortune by mastering arbitrage during the Napoleonic Wars and even famously bet big on British bonds after Waterloo. Yet, the bond market also dictates government policy. When governments fail to reassure the market, prices fall and interest rates soar. The disastrous, self-destructive cycle of defaults and devaluations turned Argentina from the world's sixth richest country in the 1880s into an inflation-ridden basket case by the 1980s. Even worse was the German hyperinflation of the 1920s, which wiped out internal war debt, causing profound social trauma and proving that this euthanasia of the rentier was a political, not just monetary phenomenon. Segment 3. Blowing Bubbles. Greed, Fear, and the Human Psyche. The invention of the joint stock limited liability company allowed individuals to pool capital for vast, risky, long-term projects. The stock market provides critical discipline, an hourly referendum on a company's future profitability. But stock markets are deeply flawed because they are mirrors of the human psyche, magnifying our swing from euphoria, or irrational exuberance, to depression. This volatility creates a predictable bubble cycle, almost always fueled by accommodating central bank credit creation. John Law's Mississippi bubble in 18th century France was the first stock market bubble. Law convinced the French government to back his monopoly trading company and finance it through his Banque Royale, issuing paper money. The result was an inflationary frenzy that ultimately collapsed France's finances and precipitated the French Revolution. Similarly, the Enron scandal demonstrated how the 1990s tech bubble, fueled by easy monetary policy under Alan Greenspan, created the perfect environment for spectacular fraud. Enron executives used financial innovation, like special-purpose entities, to conceal debts and wildly inflate assets, turning the stock into mere wind. Segment 4. The Return of Risk. Hedging Against Disaster. The world is dangerous. The basic human impulse is to save for unpredictable futures, especially against disasters like Hurricane Katrina, which submerged New Orleans. Insurance evolved as a formal method of risk management, originally pioneered not by merchants but by Scottish clergymen. Robert Wallace and Alexander Webster developed actuary principles based on probability and mortality statistics to calculate premiums for widows' and orphans' funds. This became the cornerstone of modern insurance. Today, the most sophisticated risk managers use derivatives like cat bonds, allowing them to hedge against disasters. Yet traditional private insurance often fails when mega catastrophes strike. As an alternative, many states, notably Japan, adopted the welfare state, attempting to nationalize risk by guaranteeing social security from the cradle to the grave. Segment 5. Safe as Houses, the Property Trap. The English-speaking world has a peculiar obsession with property, viewing homeownership as the ultimate safe investment. The popular Monopoly game reinforces this idea, contradicting its original intent to expose the unfairness of landlords. The U.S. government actively encouraged this property-owning democracy, using federally backed long-term mortgages, but this strategy placed an unhedged bet on a single market, property. The aristocracy learned the hard way that land is not always safe, and the Duke of Buckingham, who believed land couldn't run away, lost his wealth when agricultural incomes plummeted. The ultimate housing trap came with the subprime crisis of 2007. Through financial alchemy, risky subprime loans made in cities like Detroit were tranched and repackaged as collateralized debt obligations, CDOs, often receiving AAA credit ratings. When borrowers defaulted, the crisis spread globally, freezing credit markets and proving that the widespread perception of property as an infallible investment was merely a classic speculative bubble. Segment 6. From Empire to Chimerica, the new financial giant. In the first age of globalization, before 1914, Britain was the world's financial center, confidently investing billions overseas. But this era ended abruptly in World War I. Today, the geopolitical center has shifted, defined by Chimerica, the relationship between China, Chim, and America, Erica. China, the communist creditor, has effectively become banker to the capitalist debtor, America. China's massive savings keep its currency weak and finance America's deficits in cheap imports. This symbiosis fueled global asset market growth. However, this resolution is fragile. The rise of sovereign wealth funds, SWFs, entities created by surplus countries, now manages trillions. In a historic role reversal, these funds invested in struggling Western banks during the 2007 crisis. But history warns us that major global integration can quickly lead to unforeseen conflicts, just as the interconnected world of 1914 was blown apart in a matter of days. Conclusion. Lessons from history. The history of finance is not a smooth upward curve, but a jagged, evolutionary roller coaster of ups and downs, a series of peaks and valleys like the Andean horizon. Crises strike when confidence fails, when financial innovation outstrips our ability to manage risk, and when rapid evolution outpaces human memory. As long as human expectations swing wildly from greed to fear, volatility is guaranteed. The key lesson: financial knowledge is necessary now more than ever. It's the only way to protect yourself from the sheer cliffs of financial history. If you found this summary insightful, please hit the like button and subscribe for more in-depth book summaries.